An important principle is the economy can drive the market, but financial markets don't drive the cycle. There's clearly some worry at the moment, but if we look at the economic surprise index, that's a measure of whether the data is coming in worse or better than expected. We can see a little bit of softness, but it's nothing like we had in 2011, 2012 or 2013. And of course, none of those periods resulted in a cyclical downturn. You have to think there's going to be some damage from the market weakness. Companies are going to be a little bit more careful in investing. Consumers are going to be hesitant to consume, but this isn't going to drive a new downturn in the economy. We also have to think the central banks will be sensitive to the market turmoil. European Central Bank, Bank of Japan will be adding to policy easing in March, and the Fed isn't going to raise rates. They're probably going to wait until June, but they can't afford to wait for too long because core inflation's rising, wages are pushing up, the economy looks fine, and so we think that by June they'll be back onto this gradual rate hike cycle. So by then, the economic fundamentals will have reasserted themselves, the global economic recovery looks fine, and we think that should all be clear by the middle of this year.
It may be early days, but the year of the monkey is bringing a sense of relief or even comfort to financial markets. However, this sense of calm is not going to last for a long time, or it's not going to go on indefinitely. In our issue of our monthly investment guide titled Shifting the Blame, markets are shifting the blame to different areas. The year started where markets blame China for its currency policy, moving on to blame oil market, and thereafter more recently penalizing the European banks, and now the focus is on UK's decision whether or not to stay in the Eurozone. I will go through each of these blame factors and assess whether the developments of these factors will lead to the recent or would contribute to the recent rally in risk assets. First, on China. China policymakers are meeting in early March to decide on the economic path of China as well as its economic strategy for the next 5 years. The clarity and the outcome of this meeting will give investors assurance that China's economy is not into a hard landing. On oil market, we do see some technical rebounds on the oil market, but fundamentally speaking, the oversupply situation is still there. Inventory levels in the oil market is still very high. So oil prices will likely to remain volatile for the next month or so. And in terms of European banks, the fears of European solvency is definitely misplaced. European capital ratios have been improving over the last 5 years. Their funding situation and balance sheets have improved tremendously. But nevertheless, European banks face some headwinds, such as negative interest rates, as well as, of course, a tighter and tougher regulatory environment. There will be winners and losers in this environment, but by no means it's a big threat to the entire system. In terms of BRIC exit, UK is going to decide on whether to stay or leave in the Eurozone or the European Union on the 23rd of June. This decision is big, but so far the polls indicate that the decision is actually very close. So therefore, markets in terms of UK assets, whether it's the British pound or the UK equities, are going to be very volatile from now to 23rd of June. The blame game is going to continue for this month or so, and definitely it's not fundamentally driven, it's all on sentiments. This blame game will continue to drive markets and cause financial markets to be extremely volatile. However, on balance, we are optimistic on the global economy, on the expectations of easy monetary policy, positive developments in the US job markets, as well as the impact of lower oil prices. So taken together, we continue to favor risk assets for the medium term. At this month's tactical asset allocation, we continue to hold on to our overweight equity core. This is a decision that was made in early February, and we think that the fundamentals will gradually improve and the intrinsic value of equity prices and risk assets will slowly adjust upwards to meet with the expectations of the global economy.